How are you? This is another session. Today we are working on insurance claim. Now, when you talk about insurance claim, we're actually referring to the process which are normally followed in making a claim. The formal request by a policyholder to insurance company for coverage or compensation for covered loss or policy event. Steps of making claims. Now remember, in insurance claim we have two parties. We have insurer and then we have insured. So in the event of risk, the insured must make a claim to the insured. So these are the steps which are normally followed. Number one, making formal request. Make a request to the insurance company. And who makes the request? It is the insured. Two, validation by the insurance company. So the insurance company does the validation to establish whether the risk occurred or not. And then finally, if the risk is valid, if the incident which occurred is valid, then compensate after calculation of loss. So the loss must be calculated. The account which is prepared by the insurance company to compensate the insured for the risk they face. So these are the things that must be effected. So methods for insurance claim, there are only two methods. One is called loss of profit method. Two, loss of stock method. So these are the most important methods used in the preparation of insurance claims. So we start with the first one, loss of profit method. The following are the steps to be followed under this method. Now, when you talk about loss of profit method, we are actually establishing the loss which the business or the company is losing after the occurrence of the risk. So the business of the insurance company is to establish how much was the loss which has been caused by the incident. Now, there are processes. Number one, determine the gross profit. Now, how do you do that? You say the net profit, add the insurance charges for the last financial year, you get the gross profit, which actually will help us now in number two, determine the gross profit ratio. How do you get the gross profit ratio? You say gross profit ratio equals to gross profit divided by sales of the last year times 100. Now this gives us the ratio for gross profit. Number three, determine the shortage in sales due to loss faced. So we need to establish how much was actually lost, sales which were lost due to the risk. So actual sales of the same period of loss, you add any increase in trend of sales. So normally you will be given if it is 20%, 30%, and then you get the total sales less sales in the disposal period or dislocation period. Dislocation period is the period which the losses or the sales occurred. So you get a shortage of sales. Number four, determine the loss of profit. Now, how do you get the loss of profit? Say loss of profit equals to shortage of sales times gross profit ratio. Number five, determine the total amount for claim of loss of profit. How do you get that? You say loss of profit, add increase in the cost of working capital, you get profit, less savings, including in standing charges, amount of claim which the insurance company will pay to the insurer. Number six step, determine the amount of claim. How do you get the amount of claim? Apply the average clause method. So in the average clause method, you get the formula, policy value divided by amount insured times loss of profit claim. So these are the processes or the steps to be followed. There are 6 steps. So when you are determining the loss of profit, follow the 6 steps. Now we get into the next very important stage is actually to get the problem. So we are getting into a problem. Now this is our problem. In the problem, from the following information, 2007, the net profit for the year is 10,000. 2007 standing charges insured $6,000. Sales for 2007 is 160,000. Date of fire is 1st January 2008. Period of dislocation period is 3 months. Sales from 1st January 2007 to 31st January to 31st March 2007 is 54,000. Sales from 1st January 2008 to 31st March 2008 is 19,400. Indemnity period is 6 months. Policy subject to average clause 11,000. Trend in annual sales is 10% increase. Find out the claim under the loss of profit policy. So number 1 process, we go into the solution, loss of profit method, solution, step 1, determine the gross profit. How do we determine the gross profit? Net profit was actually 10,000. You add insurance standing charges for the last financial period, which is 6,000. You get 16,000 as our gross profit. Determine the gross profit ratio. That's step number 2. Step number 2, determine the gross profit ratio. Now our gross profit ratio is 16,000 divided by 160,000 times 100, which is giving us 10%. So 10% is our gross profit ratio. Number 3, step 3. Step 2, determine the shortage in sales due to loss faced. How do you get that? Actual sales of same period was 54,000. Add any increase in trend of sales. Remember the sale for that period is 54,000. The trend is 10%. 10% of 54,000 is 5,400. If you total, you get 59,400. This is the total sales, less actual sales in dislocation period. The dislocation period, the sales was 19,400. So when you less, you get 40,000. So shortage of sales is what? 40,000. Number 3 step, determine the loss of profit. How do you get that? Loss of profit equals to shortage of sales times gross profit ratio. Apply the formula, 40,000 times 10 over 100 gives us $4,000. That is the amount of loss of profit. Step number 4, determine the total amount for claim of loss of profit. Now how do we get this? We say loss of profit was 4,000, add increase in cost of working, which is not there. Profit is 4,000. Loss of savings in loss of standing charges, which is not there. When you less, amount of claim is 4,000. Now we come to the calculation. Step 5 is now to establish the amount of claim. How do you get that? Applying the average clause method, in our right hand, determine the current profit. To get the current profit, You see, sales for the 2017 was 160,000. Add trend, which is 16%. 10% of 160 is 16,000. When you add, you get 176,000. Applying the profit ratio, 176,000 times 10 over 100 gives us 17,600.